Now, with income-focused ETFs exploding in popularity over the last few years, a lot of investors have been turning to option-based strategies to generate consistent cash flow. In this video, we're going to be going over two newer entrants in this space, which are a little bit different than other income ETFs that you've seen, which is going to be SBAR by SPYI ETFs, as well as XV by SPYI ETFs. It's going to be the Target 15 distribution ETF, and it's going to be targeting a 15% annualized distribution rate, which is going to be paid out monthly. And SBAR is the Simplify Barrier Income ETF. Now, these are going to be a little bit different than your traditional covered call ETFs, and we'll go into that in this video. So let's first go into SBAR, which is a very unique ETF. It's a first of its kind fund that generates income by selling what's known as barrier put options. And we can see on their website, it's going to seek to offer distinct source of monthly income by selling what's known as a 30 barrier put option. And a barrier put option is kind of unique. We will explain that a little bit later. So in exchange for accepting the risk of a loss defined by the 30 barrier level, investors can expect higher levels of income than found in traditional fixed income products. And unlike traditional bond or equity funds, the downside threshold is defined ahead of time, allowing investors to make an informed investment decision based on a quantifiable personal risk level. And so it doesn't really explain what a barrier put option is on their website, but they do have some good videos on the website kind of explaining how these funds work. But basically with SBAR, there's going to be three indices, which is the S&P 500, the NASDAQ 100, and the Russell 2000 simultaneously. And it's going to be selling what's known as worst of barrier put options that only trigger any one of those indices falls more than 30% during the option's life, hence the 30 barrier put option. And most people can't trade barrier put options. They are pretty exotic and they are going to be traded over the counter. But the 30% level is going to be pretty far out of the money. As you mentioned earlier, one of those indices has to drop 30% in order for you to start losing money. Because it's so far out of the money, you're going to be collecting a little bit lower of a yield than you would with some of the traditional covered call ETFs, such as ULTY or any of the yield max ones. Because it's an actively managed ETF, we are going to have a bit higher of an expense ratio, which is going to be 0.75%, which is pretty low in terms of an actively managed ETF. Many of the covered call ETFs are 1% or even higher, like ULTY, which is 1.3%. So this is half that expense ratio. Now, if we take a look at the recent distributions, the distribution history, it's been paying since May of 27, and it's been paying 28 cents every single month, as we can see here. And the share price for this ETF is $26 per share. So if you're receiving 28 cents against a $26 share ETF, that's going to be roughly about 12% annualized yield, which is pretty respectable, and it's going to be paid out every single month. And when we take a look at the year-to-date chart, it has a 4.57% gain in share price since April of 15, when this fund first came out, April 14, 2025. So this fund has been out for 4 months now. It is a very new product, but we can see there's not much volatility with this ETF. It started out as around $25 per share and doesn't have much swings, as we can see. But with this ETF, you do have to understand the risks defined by the 30 barrier level. So if any of these indices drop 30% during the option's life, then you are going to see a significant drop as well, because you don't lose any money until any of these indices drop 30% at the end of the expiration of those options. So you do want to monitor this ETF, even though it is going to be stable short term. You do have to understand that if we're in a severe bear market, this ETF is going to drop as well. But in the meantime, you're going to have a very stable ETF, not much NAV erosion, which is going to be due to those barrier put options and the underlying strategy that is implemented by SBAR. And the key idea from SBAR is it's going to give investors steady distributions. As you mentioned, it's going to give about 28 cents per share every single month, while avoiding those frequent losses from modest market drawdowns. And as long as the market doesn't crash through that 30% floor, SBAR just keeps pocketing premium. And this is going to be a great alternative to a lot of ULTY investors who freak out over a month's loss of only about 9-10%. So if you can't really stomach short-term volatility, then this may be a great alternative, even though it doesn't pay as much distributions. It's going to be something that can help you sleep a little bit better at night. But we do want to note that if there is a severe market crash, we are going to experience some severe loss with this ETF, because we don't see any of the downside risk with those barrier put options until it crashes 30%. Then you are going to see a significant drop in the share price from SBAR, which is going to be 30% onward if it breaches that barrier. So that's some of the risks with these barrier put options. But if they're utilized well, you can make some pretty consistent cash flow, because 30% is a pretty severe crash, and that is going to be the only scenario where you're pretty much going to be losing money in this instance. Think of this as an ETF that is pretty much an insurance company. You're going to be making money over and over until something severe happens. Now let's go over its brother XV, which is going to be the Simplify Target 15 distribution ETF, and it's going to employ a similar strategy. It's going to utilize barrier put options, but it's going to provide a 15% annualized distribution rate paid out monthly by selling various barrier put options. With SBAR, it's going to be selling that 30 level barrier. So if one of those three indices, as you mentioned, is going to drop 30%, then you are going to accept the loss. In this case, they are going to sell different barrier levels in order to achieve a 15% annualized distribution rate. So investors are going to expect higher levels of income found in traditional fixed income products. And adding XV to a portfolio provides a source of potential income differentiated from traditional fixed income or volatility selling strategies. So in my opinion, you don't want to sell out of ULTY completely or any of your positions. Make this a portion of your portfolio. Don't leverage too much into one of these ETFs or any ETF. As a matter of fact, you always want to have a diversified portfolio, because in case any of these funds do end up blowing up, you don't want to blow up your entire portfolio. So if we take a look at XV, it's going to have a similar share price. But what's interesting is it's going to have a 6.57 year-to-date gain since April of 15, which has started out at around $25 per share. And if we take a look at the dividends, it's going to have higher dividends than SBAR, because this is going to be a little bit more aggressive than SBAR. It may sell some barrier put options that are a little bit more aggressive. So with SBAR, it's going to be 30% out of the money. This one could be maybe 20-25%. What they're going to do is they're going to continue to sell different barrier put option levels in order to achieve that 15% targeted annualized yield. So you're going to be getting about 32-33 cents. So it is going to be a little bit more risky in my opinion. But if you want a higher yield, this would be your ETF of choice. And because it uses closer to the money options overlays, you may get more capital appreciation as well, because it is going to be more sensitive to shorter term market moves in exchange for richer option premiums. But of course, you could lose more money as well, because it is going to be a little bit more riskier option overlays. So it's going to be the high yield sibling to SBAR, and where SBAR prioritizes downside cushion at the cost of lower yield, XV prioritizes maintaining and maximizing income and accepts that it may fall harder in market downturns. So the pros of SBAR is the downside cushion. Obviously, you're going to need a 30% plus drawdown in a single index before losses hit, which is a pretty massive drawdown for an index. A lot of single stock ETFs like MSTY can definitely experience that quite often, but when you are using an index like the S&P 500, the NASDAQ, or Russell 2000, those indexes are diversified. There's many stocks in there, and these are solid blue chip companies. And the best thing about it is that small market corrections don't trigger the barrier. So we're going to see some steady NAV, which is something that people in ULTY recently really want to see. So it's going to make it an attractive diversifier in an income portfolio for sure. But it may have lower yields compared to some other ETFs, such as QQQI, which is the NEO's NASDAQ 100 High Income ETF, which has also stable NAV, but it does have its drawdowns during market corrections in exchange for a higher distribution rate of about 14% paid out monthly. And this is a very popular ETF for good reason due to its 1256 contracts that make it very tax efficient. But the thing with these ETFs, SBAR, especially with the 30 put barrier options, is you want to get out of this ETF if you're fearing that a severe market correction is coming. And that is the way to play this ETF. You don't want to buy and hold. You want to monitor the overall stock market health to see if we're approaching those levels, because then it will give you an indicator whether or not to sell out. And in my opinion, if one of those indices drops 30% or more, that is going to be a great indicator to buy more and more. If something drops 35% like the S&P 500, I'm just going to buy tons of shares of probably call options on that index, because a lot of money can be made during those severe market crashes, especially when the market turns around. Now, if we take a look at SBAR and XV compared to the three indices, the S&P 500, the NASDAQ 100, and the Russell 2000, which is going to be IWM, we can see that SBAR and XV have remained steady while the S&P 500, NASDAQ, and Russell are down more percent than the two ETFs. We can see SBAR is only down negative 0.61% and XV is only down 0.34%. compared to the S&P 500 down 1.23% and the NASDAQ over 2%. So you are going to have a little bit more stability in share price compared to the indices while collecting steady and consistent income, which could be a huge appeal for a lot of investors. But we do also want to note from a total return standpoint where it lies. So we've compared SBAR and XV to the three indices as well as SPYI and QQQI, and we can actually see that we have higher total returns with these other ETFs. So SBAR and XV have 8% and 10% overall return respectively, while the S&P 500 is up 20%, the NASDAQ 100 is up 24%, the Russell 2000 up 26%, and keep in mind the time frame is from April 15, 2025, all the way until August 29. And we can actually see it's underperforming SPYI and QQQI by a large margin, mainly because with this ETF, SBAR, you're going to be having capped upside potential compared to SPYI and QQQI, which allow room for share price appreciation. And that is going to be some of the trade-offs. During bull markets, these ETFs are not going to be performing as well as just holding the underlying index or some of these other high income ETFs like the ones by NEOs. But where this ETF is going to shine, it is going to be flat markets where the indices are going to be break even, or gradual declines in the markets, because gradual small declines are not really going to affect SBAR or XV in any way, because it's not going to be near that 30% threshold. So in these current market conditions where we're in a severe bull market, SBAR and XV are not going to be performing as well as some of the other options out there. But this is a great complement to a portfolio if we are in a flat market or a small bear market. Now, of course, if it's a market crash and it crashes 33%, we're going to be seeing some severe losses with SBAR, because I think that it's not going to be a gradual decline down. Once that barrier is breached, then we're going to have all of the downside risk, and we can see SBAR dropping over 30% in a single day once that is breached. But of course, market crashes aren't good for any ETF, and unless it is an inverse ETF, SALTY would be a good hedge, which is a very new weekly ETF. And we do have a video on that, check it out. But let me know down in the comments what your thoughts are on these new ETFs, SBAR and XV. I feel like they are very underappreciated. Not many people know about them. Not many people understand how they work. It took me quite a few days researching how these barrier put options work. They are a unique product though, and I do think that there is potential to make some money with these ETFs.